Whereas with a cryptocurrency, we may well see it actually sort of rise or fall, within 24 hours, or certainly within a couple of days, by 20-30%. So it's a very, very volatile investment. So you then have to ask yourself, well, was it worth me being exposed to that zig and zag, the up and down, and the, oh dear, I've lost money, oh brilliant, I've made money. So was that volatile? Have I been compensated? And so back in the 60s, there was an economics professor called William Sharpe. And what he actually did was look at the variability of returns, looked at the standard deviation. How much has an investment moved from its average, deviated? And he then looked at the return on an investment and then compared the two different asset classes. So if you take, for example, the return on an investment, and as you can see on this chart here, and you actually take the return, take away risk-free. So risk-free would typically the return that you'd get by holding US Treasury bonds, and then divide that return by the standard deviation, i.e. the variance, the up and the down of that particular asset class. And that will come out with a number. That number in itself doesn't really tell you much, but if you compare the risk-adjusted returns of, say, an equity compared to the risk-adjusted returns of your property performance, or the risk-adjusted returns of having a commodity compared to the risk-adjusted returns of holding a bond, or maybe the risk-adjusted returns of your portfolio with a cryptocurrency compared to the risk-adjusted returns without a cryptocurrency. So on the next chart you'll see here, we've looked at the performance of a portfolio of 50% in international bonds, 50% in international shares. And then we've compared that with 49.5% in government bonds and 49.5% in global equities, and just 1% in Bitcoin. And if Bitcoin goes up, top slice. You're not going to get overexposed to Bitcoin. And if Bitcoin collapses, then put a little bit more back into Bitcoin. So you're constantly keeping your portfolio balanced. The reason we've actually looked at Bitcoin is simply it's got the longest track record, so we can actually look at the analysis. And again, you might look at this and say, well, what is this telling me? Because we've actually got, yes, a little bit better return by a couple of percent, but the volatility is actually not much different between these two bar charts. But if you look at the risk-adjusted returns, you'll see actually on a risk-adjusted return basis, a portfolio that had 1% exposure to Bitcoin had a Sharpe ratio which was 30% better. So this is one of the reasons why I think you're seeing more institutions looking at cryptocurrencies, because they can combine cryptocurrencies with their traditional portfolios and achieve much better risk-adjusted returns. Because I think what we're seeing equity market investors going into cryptocurrencies for their higher risk element of their portfolio. And they have been, to date, handsomely rewarded by having a little bit of exposure to that. In the same way we saw with hedge funds historically, it had performed very, very well, but the ability of them to outperform has been severely reduced, as we've seen equity markets being relatively volatile over the last few years. So another reason I think we're going to go and see more institutions coming into cryptocurrencies is if you look at this chart, and you can see here the correlation, how closely does Bitcoin perform in relation to the S&P 500 or a currency or a commodity. And you can see the correlation between Bitcoin and some of these other well-known asset classes is very, very small. It's negligible. And the reason that's important is that the first principle of investing is that you want diversification. When one thing goes down, the other thing will go up. And so by giving you a diversified portfolio, it should reduce your overall volatility. And you've now got a new asset class which doesn't appear to be correlated with some of these other asset classes. So it's an ideal way to give you a smoother return for your actual investors. So risk-adjusted returns and lack of correlation are two possible reasons why we're going to see more institutional money coming into this marketplace.